Palantir, PLTR, stock analysis. Is it still a buy at these prices? Palantir has produced exceptional gains in 2025, with the share price climbing about 147% so far this year. After such a powerful run, investors are naturally wondering what comes next. The key question is whether 2026 can deliver similar returns or whether expectations have already run too far ahead. This analysis focuses on whether Palantir is still worth buying before year end. The aim is to separate business strength from stock price enthusiasm. To assess Palantir's potential for 2026, the focus shifts to the company's fundamentals rather than recent market performance. Key areas include revenue growth trends, cash flow generation, returns on invested capital, and valuation. Together, these metrics help determine whether the business justifies its current market price. Strong long-term returns depend on sustainable performance, not momentum alone. Revenue growth is the natural starting point. Palantir's revenue expansion stands out because it is gaining speed rather than slowing down. Since 2018, revenue has increased from roughly $600 million to about $3.9 billion in the latest 12-month period. That translates into a compound annual growth rate of approximately 32%. More notably, recent quarters have significantly exceeded this pace. In the latest quarter, revenue growth reached 63%. This acceleration reflects Palantir's growing success in the commercial sector. While the company historically thrived on government contracts, enterprise adoption had been more challenging. Recently, that dynamic has shifted as Palantir refined its go-to-market approach. Enterprises represent a far larger and more scalable customer base. This expansion meaningfully increases Palantir's long-term growth runway. Profitability improvements have been just as striking as top-line growth. Returns on invested capital have surged to around 75%, placing Palantir among the strongest performers in this category. Just a few years ago, these returns were deeply negative, highlighting the scale of the turnaround. Revenue growth has been paired with disciplined cost management. This signals a business that is becoming both larger and more efficient. Operating cash flow trends reinforce this positive picture. Palantir's operating cash flow margin has risen from negative levels in 2020 to approximately 46.6% today. That places the company near the top of its peer group. Even with increased hiring and investment to meet demand, cash generation continues to improve. This demonstrates strong operating leverage. Overall, Palantir combines accelerating revenue, industry-leading cash flow, and exceptional returns on capital. The company operates at the heart of the artificial intelligence sector, where demand from governments and enterprises continues to surge. These characteristics justify a valuation premium. Even before examining the stock price, the business quality is evident. The challenge lies in determining how much investors should pay for it. When valuation is analyzed, concerns begin to emerge. Palantir trades at a forward price to earnings multiple of about 203, alongside a forward price to operating cash flow multiple near 192. These figures are nearly 9 times higher than the average S&P 500 stock. While Palantir is clearly superior to the average company, the magnitude of this premium is difficult to justify. Expectations are extremely elevated. Paying a premium for a high-quality business can be reasonable, but this level stretches the limits of comfort. Even a forward PE closer to 100 would already imply aggressive assumptions. At over 200, the valuation leaves little room for error. Any slowdown or unexpected weakness could trigger a sharp re-rating. Risk increases as valuation expands. Palantir is often compared to other expensive stocks, particularly Tesla, but the comparison is misleading. Palantir is currently delivering strong revenue growth, rising cash flow, and improving profitability. Tesla, by contrast, is facing declining revenue and shrinking margins. Palantir's valuation is supported by measurable execution rather than speculation alone. Even so, strong fundamentals do not eliminate valuation risk. A discounted cash flow analysis provides another way to assess value. Based on updated assumptions, Palantir's intrinsic value is estimated at approximately $99 per share. The current market price sits around $187, while intrinsic value has steadily increased throughout 2025 due to strong performance. The share price has consistently stayed well ahead. Investors appear to be pricing in future success well in advance. Retail investor enthusiasm has played a major role in sustaining this elevated valuation. As a result, Palantir has rarely traded near fair value in recent years. The last time valuations appeared reasonable was several years ago at much lower prices. Today, optimism is already embedded in the stock. This limits upside potential while increasing downside exposure. So, is Palantir an attractive buying opportunity going into 2026? At current prices, the answer is no. The business itself is outstanding and deserves a premium valuation, but the current pricing appears excessive. A single weak quarter or cautious outlook could lead to a significant correction. For now, Palantir is better viewed as a hold, with patience required for a more attractive entry point. One way to estimate a reasonable buying opportunity is by reviewing analyst price targets. At present, Palantir is covered by 26 analysts. Among them, 6 rate the stock as a buy, 17 maintain a hold rating, and 3 have issued a sell rating. This mixed outlook reflects both strong business performance and valuation concerns. Analyst sentiment provides a useful reference point rather than a definitive answer. Looking at price targets, the highest estimate stands at $255, while the lowest sits at $50. In my view, the lower target appears unrealistic unless there is a major deterioration in Palantir's fundamentals. The median price target of around $200 seems far more reasonable based on current performance. Applying a margin of caution, I believe the stock could trade in the $185 to $190 range over the next 12 months. When I invest, I generally aim for at least a 25% return within a 1-year period. Palantir's revenue growth remains on track, and earnings per share continue to align with analyst expectations. Importantly, there has been no significant negative shift in the company's fundamentals. Given this backdrop, upside potential depends heavily on entering at the right price. Based on this framework, I would consider Palantir attractive in the $140 to $150 range. Buying within this zone would provide a reasonable path toward achieving a 25% return if the stock approaches analyst midpoint expectations. This entry level balances growth potential with valuation discipline. It also aligns well with broader analyst forecasts. Finally, this is not a promotional discussion or an endorsement of Palantir as an investment. I conduct valuations because I genuinely enjoy the process and it aligns with my academic background in finance and accounting. I hold both a bachelor's and a master's degree in these fields, and company analysis is something I'm passionate about. As always, invest with caution and happy investing.